Good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation today of how to discover winning stocks in Trump's presidency. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. Now, as a reminder, this webinar is being recorded, and a copy will be sent to everyone who has registered. Please submit your questions throughout the webinar using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen.
85% fundamental, 15% technical. And I created the model because self-directed investors didn't really have the tools and the discipline to successfully manage their own money.
And that's created by famous analyst and entrepreneur Marc Chaikin.
I'm a big fan of Marc Chaikin, though, so it makes me nervous, Scott, because I like his metrics of looking at the market.
Marc Chaikin.
Marc Chaikin.
An expert known on Wall Street for developing computerized stock selection models.
Joining us is Marc Chaikin. He is the founder of Chaikin Stock Research. Mr. Chaikin, welcome.
Thank you, Joe, and welcome everybody. Appreciate you taking time out from a semi-holiday afternoon to set yourself up for winning 2017 in the stock market, whether you're an options trader, swing trader, or investing for your retirement. So in today's webinar, I'm going to share with you some of what I've learned in 50 years on Wall Street. During that period, I've survived 10 bear markets. I don't see one anywhere in the near future, so that's encouraging. And for 45 years, I've been using technical analysis to help survive bear markets because I learned very early on that although fundamentals drive the market, as you'll see in a minute, you need technical analysis to preserve capital and keep you sane in bear markets. And very critical combination that I've zeroed in on in 45 years of successful career on Wall Street, guiding investors, working with big institutions. So along the way, I have been mentored by some of the smartest and most successful institutional investors. Some of them were colleagues, others were clients. But what I learned from them is very important for this presentation because I took what I learned from the most successful investors and I created the Chaikin Power Gauge rating in 2010 in response to the financial collapse of 08. I came out of retirement because I felt that individual investors and even advisors needed better tools in markets as we came out of that terrible financial collapse. And so the Power Gauge rating is really the culmination of my life's work. I'm going to share what goes into the rating with you because it's critical. We've been fortunate in that the media has given us a lot of press. Barron's called us one of the top quantitative sites on Wall Street. Some of the biggest and most successful hedge funds like Paulson Hedge Fund and Soros are using us. And we've started partnering with some of the very, very successful advisory firms like John Carter at Simpler Trading, John Malden at Malden Economics, and now Benzinga. So I'd like to give a big shout out to Jason Raznick and Mike and the whole Benzinga team for turning out a great crowd for today's webinar. Now, in the next 45 minutes, I'm going to help you prepare yourself for 2017. We're going to look ahead at what to expect in 2017, show you how to find winning sectors, groups, and stocks for the new year, and very importantly, how to avoid losers, because I believe 2017 is going to be the year of the stock picker. And we'll show you why in a minute. And in a stock picking environment, you have to be able to avoid the losers. So before we look ahead at 2017, I'd like to get a feel for what's on your mind. What's troubling you regarding your investments or your trading? Are you concerned about what the Trump presidency is going to mean for the stock market? Do you think rising interest rates are a problem? Do you have a plan for 2017? If you do, please type that into the Q&A box so we can get a feel for what's on your mind and hopefully address as much of that as we can in today's webinar. So I see the uncertainty about the presidency. Thank you, John. Healthcare, where is that headed? Obviously, that's on everybody's mind. Bill, thanks. I see Mary is concerned about whether interest rates are going to really derail the bull market. So I'd like you to think about whether you have a plan for 2017. It's absolutely critical, especially when you head into a new administration and a new year, to have a plan, because every presidential cycle is different. This one even more so. And having a plan for 2017 is very important. So let's see if we can zero in on where the best opportunities to make money will be in 2017. Well, one place that I don't think they're going to be is in the bond market. We've had a 30-year bull market in bonds that culminated in the zero interest rate environment that we've been in, where 10-year treasuries were yielding as little as 1.3% as recently as July. But the decline in bonds and the rise in interest rate didn't just begin after the Trump presidency, as you can see, or victory in November. As you can see from this one-year chart of the TLT, the 20-year Treasury ETF, bond prices peaked in late June. Yields were at their lows of about 130 on the 10-year, and they had broken down with very, very heavy selling pressure in this ETF. This is the Chaikin Money Flow. Many of you know me for my technical indicators. Some of you are for the first time going to hear about the Chaikin Power Gauge rating, which is our fundamental indicator. But the bottom line is, even though we've had a little bit of a reflex rally and bond yields have dropped from about 260 down to 240, the bull market in bonds is over. The Fed has told us that. They're expecting 3 interest rate hikes in 2017. And if some of the Trump agenda is implemented, tax cuts, infrastructure build, rebuild the military, it's going to create higher interest rates, higher inflation. So if bonds are not the place to be, then if you're going to fund your retirement, or if you're looking for trading opportunities, it's in the stock market. So what we have up here is a one-year chart of the SPDR, the S&P 500 ETF. It's the most actively traded instrument in the US markets. And we can see, going back to the double bottom in 2016 in January and February, that Chaikin Money Flow, which looks back over 21 days and measures institutional buying and selling, was extremely strong even as we were making that low, showing you that institutions were starting to buy the market as early as February of 2016. And Chaikin Money Flow, which typically fluctuates between red and green, which is what it's doing here on the right side of the chart, stayed almost universally green from January through September of 2016. That told us that institutions were accumulating stocks. Even with that big sell-off here in Brexit in June, it was a 2-day sell-off. It was well contained. And now we use that as the bottom of our trend channel. So if we look at what's happening now in the market, because the S&P 500 does represent the 500 largest cap stocks, and it is the market for many people, although small cap stocks have begun to outperform the large cap stocks and have been for quite some time, we've been in this trend channel. We bumped up against 2275 here in early December. We pulled back, and the upper channel now is in the 2300 area. It also coincides with our upper volatility band. So as many of you know, we're in earnings season. Earnings season is often an impetus for the market to move higher or lower. We expect fairly positive reports. They started on Friday with the major banks reporting better than expected earnings. But we still have this hurdle to overcome, which is that upper trend channel and our upper volatility band. So in general, we're bullish for stocks in 2017. And it's important to know what to focus on in order to find the stocks, the ETFs, the sectors that will help you make money in a bullish environment. So what you should be focusing on in 2017 is the trend of corporate earnings, and we're getting a clue about what the fourth quarter looked like in earnings season right now. Where are interest rates headed? What sectors and groups will be strong and weak in 2017? And our old friend volatility is something you should expect more of in 2017. Now, the most likely scenario for 2017 is pictured on this chart from Bank of America Merrill Lynch. Now, we'll just back up a bit. After the financial collapse of '08, between 2009 and 2014, we had the most bullish scenario for stocks: falling interest rates and rising earnings. Now, earnings were rising at a very modest pace. GDP was growing at 2 to 2.5% a year. There were productivity enhancements, and we had a very, very fine bull run. And then in 2015, we went into what is a bearish scenario for stocks: falling rates and falling earnings. Now, part of that was due to the energy complex, which was in a bear market in 2015. But in general, the market held up very well because the FANG stocks, Facebook, Amazon, Netflix, and Google, and Apple, all carried the large cap S&P 500, which was up just fractionally in 2015. So even though it was a bearish environment for stocks, unless you were in the energy complex, you did pretty well in 2015. But now we've moved into 2016-17, and we're back into a bullish scenario for stocks, which is higher interest rates and rising earnings. Now, we had for 6 quarters what is known as an earnings recession. Up until the 3rd quarter of 2016, year over year, corporate earnings were down, mostly because of the energy complex. And people expected a bear market. Many people on CNBC and in the press were predicting a bear market because earnings were falling for 6 straight quarters. We reversed that in the 3rd quarter of 16. And now, as we see 4th quarter earnings reports coming out in January, we expect that trend to continue of year over year gains in earnings. So we've ended the earnings recession. You don't see too much talk of a bear market now. But we are in an environment of rising interest rates. So it's important to know what happens in a rising interest rate environment. Well, first of all, the market goes up. Over the last 40 years, in periods of gradually rising interest rates, the stock market moves higher. And there's a good reason for that. Typically, if the Fed is raising rates, as they did in December of 15 and then in December of 16, they're doing it because they think the economy is strong and they don't want it to get overheated. So we're at a pretty close to full employment level. Wages are rising and the Fed is gradually raising rates. But we are in a period of rising earnings, and hopefully the Trump administration, with their aggressive agenda to rebuild the infrastructure and rebuild the military, cut taxes, cut regulations, will lead to an expanding growth rate. Maybe we break out of the 2 to 2.5% GDP growth and get it over 3 to 3.5%. That remains to be seen. That's part of what's fueling this huge advance that began a couple of days before the election. So here's where sector performance becomes so important, and Chaikin Analytics will help you do that, but I just want to set the stage. When interest rates are rising, and this looks back over 40 years, there's a very definite pattern of what sectors do well and what sectors do poorly. Now, the sectors that do poorly are the defensive sectors: utilities, telecom, consumer staples, and healthcare. They typically carry higher yields, but when interest rates are rising, people are looking at stocks. And the sectors that go up in a rising interest rate environment are very well defined: financials, industrials, technology, materials, and energy. These are the sectors that benefit from an expanding economy. Consumer discretionary is an outlier. And there's a good reason for that. Consumer discretionary sector covers a wide range of stocks, from home builders to retailers to Amazon. It's not a homogeneous sector. It's very diverse. and therefore it fits out of the norm. So let's see, based on real-world performance over the last 3 months, if the history is going to repeat itself. And in fact, it has been repeating itself. This, from our sector performance and ETF capability, looks at the 10 select spider sector ETFs, which breaks the S&P 500 large cap index down into 10 sectors, and shows you the performance of those sectors ranked from strongest to weakest over the last 3 months. And sure enough, there's financials up almost 20%. That's the large cap. Small cap financials are up, in many cases, 40%. Industrials, that would include aerospace and defense. It would include the companies that will benefit from infrastructure build. Materials, consumer discretionary, again, the outlier, energy and technology. So we're holding true to form. And then at the bottom, real estate, which has been broken out of the financials, consumer staples, utility, and healthcare, the 4 weakest performers in the last 3 months. So history is now repeating itself, and in my opinion, will continue to repeat itself through 2017. And we'll end the webinar by showing you how to find the strongest sectors and the strongest stocks in those sectors. The final piece of what you need to focus on in 2017 is volatility. Now, volatility is not a recent phenomenon, but we know that people are spooked by volatility. They're spooked by corrections in the market. In fact, how many of you are comfortable buying a 5 to 10% correction in the market? If you are, put a big C in the Q&A box, please. Because it's really important to know, and the next slide is going to reinforce this, that volatility can be your friend, and declines in the market, when you know with some degree of confidence that you're likely to be going up, are buying opportunities. So every year has experienced significant corrections in the stock market. Over the last 30 years, the annual correction has averaged 14%. That's a little bit distorted by the 4 bear markets we've had in the last 30 years. But those who stay the course were rewarded. Now, it doesn't mean you have to stay fully invested, but it means knowing how to raise cash at the appropriate time and then put it to work. So I wanted to wrap this up by putting pullbacks into perspective. Since 1945 in the S&P 500, there have been 75 declines of 5 to 10%, a little more than one a year. And what's interesting is they tend to last 1 month, and then within a month, they recover back up to new highs. So these are normal. Pullbacks are normal. They are your friend. You should look for them to put cash to work, especially in a bull market. Now, there have been 11 bear markets. Bear market is defined as the S&P 500 dropping 20% or more. 11 bear markets in 72 years. About one every 7 years, 6.5 years. Now, there's a real message here, because I know you watch CNBC and you see people predicting bear markets all the time. And there are people called perma-bears who are always bearish. Well, if there have only been 11 bear markets and you're constantly looking for the next bear market, what happens? You're missing out on opportunities. You're going to miss out on the opportunities that we're going to show you how to find in a bull trend. So let's zero in on one of the key problems, and a couple of you identified this in response to my query about what's on your mind. There's so much information out there. How do you know who to believe and what to look for? It's a flood of information, and it can overwhelm you. Our solution to information overload is Chaikin Analytics. And the examples we're going to use in this webinar to teach you some very important patterns that I help identify winning stocks are all from Chaikin Analytics for either desktop, browser-based, or the iPad. Now let's start with a few core principles that I believe in and that drove me to build the power gauge rating, and that I think you need to acknowledge if you're really going to make serious money, whether you're a trader or you're an investor. First of all, fundamentals drive the market. Even though many of you know me for the Chaikin oscillator and Chaikin Money Flow and our trading bands, technical indicators that I worked on for many years, I always realized that fundamentals were the underlying driving force, because institutional investors who drive the market movements for sectors, stocks, industry groups are basically fundamentally driven. So earnings drive stock price trends, valuations matter. You don't want to pay too much, as in the case of stocks like Tesla, for $1 of earnings. And sector and industry group trends are very powerful. I group all of those under the label of fundamental factors. But if fundamentals drive the market, emotions drive the market to extremes. And here's where technical analysis comes in, because price movements are amplified by fear and greed. Investors have the same psychological makeup today as they did when I started in the business over 40 years ago. And crowd psychology continues to push investors into the same stocks, whether they're institutional or individual investors. But technical indicators help you quantify or measure these extremes so that you can take advantage of them instead of being spooked by these movements, which sometimes come out of thin air. So the way Chaikin Analytics leads to consistent profits, whether you're an options trader, a swing trader, or managing your retirement funds, is that by combining fundamentals with technicals into a quantitative model, we give you a directional edge. And then we provide 6 pairs of buy and sell signals to help better time your exits and entries. Now, the whole key to making money in 2017, and really in any year, but particularly in a year where there's so much change going on in Washington, the way the president communicates is a game changer. Tweeting about automobile companies, defense contractors, where he thinks that pricing is too high, drug companies. There's a whole new dynamic in the market, so you need a disciplined methodology. The volatility is coming from the top, which is a big change from the last 8 years, where we had a very calm president. We've got a much more volatile, voluble president. So this pyramid encapsulates the Chaikin methodology. At the top is the power gauge rating, very simple gauge, but very powerful analytics, and industry and sector rankings. At the bottom, 2 only technical indicators, Chaikin Money Flow and Chaikin Relative Strength. Now, how many of you use technical indicators to help you make your investment or trading decisions? If you do, type a big T into the chat window, please. And as I expected, about half of you use technical indicators. And I think that's really important, but you don't have to look at too many of them. In our methodology, money flow, which measures institutional buying, and relative strength, which, as we'll see, is really critical. And then, of course, we have our buy and sell signals, and they could be your own buy and sell signals. If you use candlestick patterns, you get good buy and sells. If you follow a particular market methodology from someone like a John Carter or any of the other really proven trading gurus, although I don't like the word guru, but John Carter is, Steve Bigelow with his candlestick charts and so forth. Signals are very important. Ours are good, and there are other good signals out there. So the Chaikin Power Gauge rating is displayed as a very simple gauge that varies from very bullish to very bearish. But please don't confuse simple with simplistic, because the power gauge rating is very powerful under the surface. I like to say that the power gauge rating is like a Chevrolet with a Ferrari engine under the hood. And the reason I say that is because it combines 20+ technical and fundamental factors. John Carter of Simpler Trading, who's one of the best traders I've ever known, called the power gauge rating an awesome meter for stocks. He said there's a lot of hyped up tools, but when I find something interesting, I'll let you know about it. So you can imagine that a single tool that combines 20 plus technical and fundamental indicators got my attention, and he called it an awesome meter objective for stocks. Now, what did John Carter see in the power gauge rating and the 20 factors to make him so enthusiastic? Well, he saw these 20 factors, which, as I said in the beginning, represent the culmination of my life's work, working with institutional investors, understanding what they looked at before they made investment decisions. So in a one-year period of research, I took 200 factors and distilled them down to 20 and grouped them into these 4 components. And in the 6 years that they've been commercially available, since January 2011, they've done an extraordinary job of identifying stocks that are likely to outperform or underperform the market. Now, the financial metrics make up 35% of the model. They're what a Warren Buffett would look at, and free cash flow and price to sales ratio are the 2 key metrics in that financial grouping. If a company's throwing off cash flow, that's critical. You can manipulate earnings, but cash is cash. And the notion of paying too much for a dollar of revenue, something value investors pride themselves on avoiding, is also critical. Now, earnings are important, and we're in the middle of earnings season, so you see that one of the 5 factors in the earnings component is earnings surprise. Now, let me tell you a little story about how I learned about earnings surprise. I was at Drexel Burnham in the mid-'80s, and a gentleman named George Douglas had built a quantitative database. It was one of the 2 quantitative databases on Wall Street. And George gave me access not just to the database, but to his research on earnings surprise and earnings estimate revisions, both of which are factors in the model. What George discovered was that when a company reports a positive or a negative earnings surprise, and we're going to be seeing a lot of that here in earnings season, they tend to come in bunches. There's rarely just one of them. You get a string of positive earnings surprises because a company's business is improving, or you get a series of negative earnings surprises when a company's business is under attack from competition or when their business model is broken. And earnings surprise leads analysts to raise or lower their estimates. And analyst estimates revisions are the single biggest short-term driver of stock price movements. So the financial metrics are the bedrock. They don't change very often, and they're the longer-term factors that are at the foundation of the model. But we also key in on shorter-term factors. And then we look at things like short interest, because short sellers are very smart and they do their homework. And if there's a big short position in a stock, the model views that as negative. We also look at insider activity, particularly focusing on insider buying. What could be better than having the insiders buying their own stock? But in this webinar, we're going to focus on industry group and sector relative strength, which is one of the 20 factors in the model and really is critical, as we'll see when we wind up the webinar. And by the way, we're going to introduce at the end of the webinar a very exciting new piece of functionality that we've added to Chaikin Analytics that helps you find new ideas in a very contemporary way. And we've got a special offer for you at the end of the webinar. So how is the power gauge rating done? Well, this life-to-date chart goes back to '99, and it combines the back-tested results, which always look good, with the real-time results, which also look good. And using the Russell 3000 as our universe, the very bullish stocks in the Chaikin power gauge ratings have been up almost 20% a year over the last 16, 17 years. And the very bearish stocks, even after a 7-year bull market, are actually down 1%. Well, now let's zero in and see what happened in 2015 and 16. As I alluded to earlier, 2015 was a difficult year. The average very bearish stock was actually down 17%, even though the S&P 500 was up a fraction and the Russell 3000 was down only 1%. Energy stocks were in a bear market. So if you own Range Resources or Pioneer, or even some of the large energy stocks and offshore drilling companies, you are living in a bear market. The very bullish stocks were down only 1%. And then in 2016, as we moved into that favorable environment that we saw of rising interest rates and rising earnings, the average very bullish stock in the Russell 3000 up 32%. Now, how many of you were up 32% in your account last year? Or 29% or 25%? These are the questions you have to ask yourself to evaluate whether you've got the right tools going into 2017. Now, the very bearish stocks were up in 16, but they were up only 9.53%, less than the Russell 3000 itself, which was up 15%, and a very wide spread between very bullish and very bearish stocks, just as there was in 15. So it's critical to focus in on the very bullish or bullish stocks in the Chaikin model and avoid the bearish stocks or use them as put candidates. So we'll see as we go through the webinar. Now, the key to finding the winners in 2017 starts with a pattern that we call classic Chaikin bulls. The power gauge rating is bullish, indicating that the fundamental potential for that stock is positive. The 20 factors are aligned in a bullish way. Relative performance to the market is strong, and Chaikin Money Flow is strong, indicating that institutions are accumulating the stock. So just 3 things to look at. Now, obviously, that's a simple methodology. Well, guess what? It works. My wife, Sandy, who started out in marketing and PR for Chaikin Analytics after a long career in marketing, cosmetics, and travel and tourism, 4 years ago, she decided, after never having bought a stock in her life, to master the Chaikin methodology, and she sort of made it her own. She looks at these 3 factors: Chaikin Money Flow, relative strength, and the power gauge rating, and then a couple of other things, 2 factors in the rating. And she teaches this on a webinar that she calls the 5-step method. So simple is really better, in my view. Too many investors and traders overcomplicate things. They look at too many indicators, too many different approaches. So here's an example of a classic Chaikin bull. United Health, the largest healthcare provider in America, they made a very wise decision to back out of the Affordable Care Act because they were losing money. And because of that, United Health has been making new highs when other stocks in the healthcare group have been making either new lows or going nowhere. So why was this a classic Chaikin bull? Well, at the bottom of this 1-year chart, we have a red, green, yellow ribbon that tells you what the power gauge was doing at any given point in time over the last year, and we have a 5-year chart so you can go back even further. Right above that, we've converted relative strength into a heat map. Now, I know many of you look at Investors Business Daily to find your relative strength ranks or ZACs. Typically, they're a number. Investors Business Daily, it goes from 1 to 99. Well, numbers, in my view, contribute to information overload. Isn't it easier to look at this chart and know that if the relative strength is green, it's outperforming the market for that particular trading instrument, and if it's red, it's underperforming? And then we've got Chaikin Money Flow, which measures institutional buying and selling. And then we see some examples on the screen of the sell signals and buy signals we have in the system. In this case, we're looking at an oversold buy signal. It's really simple. I owe this one to Larry Williams, who has been my mentor in terms of the original research he did in accumulation and distribution. This is a more recent pattern that he discovered. If a stock you like, and in this case we use the power gauge rating to determine like or not like, is bullish, and the stock makes a new 8-day low and gets oversold, that's a buying opportunity. Now, do these signals work all the time? Of course not. They work about 2 out of 3 times. They're great for swing trading and options trading. The typical duration of this signal is 5 to 10 days. We have a relative strength signal that keys on whether a stock is strong or weak, has a pullback and then reverses, and that has a time frame of 4 to 8 weeks, and we'll see some examples of that. All 6 signals are on our website, 6 pairs. Whether you're a visitor or a subscriber, we give you a look inside how these signals are constructed. Now, it's also important to know the classic bear pattern, because these are the stocks that you need to avoid or go short or buy puts on. Power gauge ratings bearish, the stock's underperforming the market, and Chaikin Money Flow is red, not green, telling you that the institutions have been selling the stock. Now, we've been using Chipotle as our poster child for the classic bear for over 12 months. Why? Because way off this chart, at a price of about $6.90 on the way down to $3.58, the power gauge rating on Chipotle turned bearish, and it started underperforming the market. And that was all before the E. coli crisis destroyed their image in the marketplace. And notice that there have been many opportunities along the way to either get out of Chipotle if you didn't follow the first set of negative indications, or to buy put options. And even though recently the management said things may start looking up, the power gauge turned neutral, but it's still underperforming the market. And so you've had 16 months where the stock went from $6.90 all the way down to $3.58, where if you followed the Chaikin methodology, you were avoiding Chipotle or buying put options. And we've seen put spreads that come from our options module. And notice up here at the top, we see that analysts are still lowering their estimates. Same store sales have just not improved. And so the likelihood is that this stock is going to run into resistance every time it rallies, because there's a lot of people who are still stuck in this. Now, we get the question all the time, how do I find the bullish and bearish stocks? Well, we have hot lists in Chaikin Analytics that are computer generated. And I just took a snapshot of all the stocks where the power gauge rating turned bullish last week. There were 137 of them out of the 5,000 stocks that we rate every night in the model. And this is a way to sort of narrow down the universe and then do some other things, looking for signals as entry points. So how can you profit in 2017 very specifically? Well, we want you to be able to find bulls and bears, and for us, the best way to do that is the combination of the fundamental and the technical, the Chaikin power gauge rating to measure the fundamental potential, and relative strength to tell you whether the stock is outperforming or underperforming the market. And you're going to see some very specific examples in a minute that show you these changes as they filter through the market. You can also make money by using Chaikin Money Flow, which is on every online brokerage platform. It's on Reuters or Bloomberg if you're a professional advisor. It's on stockcharts.com, not just to tell you whether institutions are buying and selling, but we're going to show you 2 patterns that we've been teaching institutional investors for 30 years that enable you to predict future price movement based on Chaikin Money Flow. And then finally, we're going to show you how to zero in on the best sectors and industry groups. And to accomplish all this, we're going to zero in on 3 key indicators, and there are 3 important takeaways that you're going to come away with from this section of the presentation. We call these 3 takeaways the dynamic duo, personality changes, and stealth accumulation and distribution, and they're all based on the power gauge rating, relative strength, and Chaikin Money Flow. So what is the dynamic duo? Well, it's our way of combining fundamentals with technicals. Chaikin power gauge rating and relative strength, and the dynamic duo helps you find big winners and losers when they agree. So here's an example of actually all 3 concepts that we just talked about. We'll start at the bottom with the Chaikin power gauge rating. Here's a stock called Quanta Services, symbol PWR. And the reason it has that symbol is it provides infrastructure for the power generation business. And the stock, even long before the surprise Trump victory in November, was under heavy accumulation. The power gauge turned bullish in February when the stock was about 22, 21. It started outperforming the market in April. There's your bullish personality change. And when both the power gauge rating and relative strength are green, that means the dynamic duo is strong. And if you see heavy accumulation, this is a stock you want to buy on weakness, and these are those relative strength buy signals that I mentioned. Very simple signal. If a stock is outperforming the market and dips below its 21-day average and then rises back above it, we use a 21-day exponential, we call that a relative strength buy. These signals tend to last 4 to 8 weeks. And again, they're accurate about 2 out of 3 times. Typically, when they're not accurate, the market is in transition from a bullish phase to a bearish phase. And we see a pattern that we call stealth accumulation, which is one of the ways that you can use Chaikin Money Flow to predict future price movement. Very few indicators give you the ability to predict price movement based on technical analysis. So what do we mean by stealth accumulation? Stocks go through cycles. They'll hit an upper volatility band, they'll pull back or go sideways, and usually money flow goes negative or red in that process. But when Chaikin Money Flow stays green or positive, even though a stock is correcting 10% or going sideways for a month, it means that the institutions or the insiders, the knowledgeable people about that stock, are actually taking advantage of price weakness to accumulate more stock. They're not contributing to the weakness, they're using it to their advantage, and you can as well. Now, here's another example of the dynamic duo and the personality change. This is Coca-Cola, a name we all know. You would think, well, been in business for 100+ years. They know what they're doing. It's a worldwide brand. The fact is, it's been a terrible place for your money because we had a bearish personality change back here in April with the stock at about 45. And then in May, the power gauge turned bearish. So there's your dynamic duo. The market agrees with the model. And then as we started trending lower heading into the election, money was coming out of this stock. And the question you need to ask yourself is this a stock that you would have liked to have owned in 2016? And I think many of you would say, hell no. Well, here's an interesting screenshot. Just last week on CNBC, they're talking about the Trump rally. They said Goldman Sachs downgrades Coke and Procter & Gamble to sell. Well, where was Goldman Sachs with one of the best research departments on Wall Street back here in May when the stock was 45? You have to question whether Wall Street has all the answers. That's why I created the Chaikin Power Gauge rating, to level the playing field, giving individuals, self-directed investors, and professional wealth managers the same tools that the large institutions like Fidelity and T. Rowe Price have been using for years. So don't be dependent on Wall Street gurus, on Wall Street brokerage firms, on barons. Become independent. 2017 is a change year for the stock market, and in Washington, make it a change year for yourself. Become independent, sleep better, have the confidence to pull the trigger and take advantage of those 5 to 10% corrections that come along once or twice a year. Now, the concept of personality changes is the second pattern I want you to take away. Personality change is something we define as a stock that's been outperforming the market where relative strength is green and then starts underperforming the market, just as in the case of Coca-Cola. And here's another example of a bearish personality change. This is Nike, again, another worldwide brand that's been a terrible investment in 2016. The stock saw the power gauge turn bearish with the stock around 60, had a bearish personality change. Money was coming out of it all year. Sell signals along the way, in this case, our relative strength sell signals. So the dynamic duo was weak. The market agreed with the model, but in this case, it was on the downside. My old friend Marty Zweig, who sadly passed on too young, was one of the first popular quantitative analysts on Wall Street, also a great market technician. And he said you can make money in the market by doing just two things. Watch the Fed and listen to the market. And what he meant by that was, no matter how good your fundamental research is, if the market doesn't agree with you, you've got to perk up your ears and wonder why. Because at best, it's dead money, and at worst, it's a disaster in the making. So you always want the market to confirm your fundamental judgments. In this case, we don't make fundamental judgments. The power gauge does the heavy lifting. Now, here's an example of a company that did more than just go down. This chart ends in April of 2014. This is SunEdison, one of the biggest, most popular names in the solar energy complex, where hedge funds had big positions and firms like Merrill Lynch had buy ratings on it as it made its peak at $30. But the power gauge was looking at the fundamentals and what the analysts were saying and doing, and whether the company was reporting positive or, in this case, negative earnings surprises. And so the power gauge rating turned bearish in mid-July of 2014 with the stock at around 28. It then had a bearish personality change. So the dynamic duo was weak, and look at all that money that was coming out of that stock. If I put my hand over the chart, just where this little insert from CNBC was, and ask you whether this is a stock you would buy or sell, I think most of you would say, I'm a seller of this stock. And ultimately, they filed for bankruptcy in April of 15. And along the way, Merrill Lynch did put out a sell recommendation, but guess where the stock was? It was $3 a share in January, down from 30. And at a show that we did in May of 16, I use this as an example. It was an options show out in California, Options Industry Council. And a broker from Merrill Lynch came up to me as I was demonstrating the system in our booth. And he said, oh my God, if I had only had Chaikin, I would have saved a lot of pain and money, because I bought SunEdison on the way down at 15, which Merrill Lynch was still recommending. If I'd been using Chaikin, I could have saved myself and my clients a lot of money and pain. And that's really the crux of the whole Chaikin methodology. Avoid disasters. You may avoid an occasional winner, but that doesn't matter. There's an old saying in New York, where I spent 20 years before moving here to Philadelphia: never run for a bus, because another one's going to come along in a couple of minutes. It's the same with stocks. You don't have to chase stocks. You don't have to buy bearish stocks. There are 5,000 stocks to trade. You want to put the odds on your side by avoiding the very bearish stocks that are underperforming the market. Now, the third pattern that I want you to come away with, you've already seen a little clue, which is stealth accumulation, and then a very specific sell signal relating to Chaikin Money Flow. Institutions have gotten so big that they can't execute their orders on one day or even in 1 week. So they like to fly under the radar screen because they're paranoid about people knowing what they're doing and running ahead of them. And that created that pattern of stealth accumulation that we saw just a minute ago. But here's another example of stealth accumulation. This is a company, it's a small cap stock that's done extraordinarily well because they were a garden supply company, and now they've moved into pet supplies, which is a very lucrative business these days, called Central Garden, symbol CENTA. Dynamic duo was strong. It was a small cap stock, which has been doing well in 2016. And look at that accumulation. We call that stealth accumulation, because even when the stock sold off between August and September for a period of 4.5 weeks, were the institutions or the knowledgeable insiders selling the stock? No, they were buying it. You can see that very clearly through Chaikin Money Flow. And the stock, after a whole series of overbought and oversold conditions, spiked up to new high after the election. Money flow was still strong. It pulled back a bit, and then here's the real secret that Wall Street insiders have been learning from Chaikin Analytics and from our predecessor companies for 30 years. If a stock makes a new high near the upper volatility band and money flow is red, not green, we call that a bearish money flow sell alert. It's one of the only technical patterns I know that can help you get out of a stock at its high with some degree of confidence that you're not leaving a lot of money on the table. Many people are reluctant to sell a stock that's making new highs, and in most cases that's accurate if money flow is strong. But when you see that pattern, it's telling you that the institutions, the insiders, the smart money is selling that stock while the public is buying it, and you want to follow the institutions. It's a great way to get out of a stock and take your profit. Now, the power gauge is still bullish, and so is relative strength, so I'm not looking to short that stock, but I want to be out of stocks like that when I see that pattern, and it happened a second time. So you got a double top with money flow negative each of those two times, and now you've had a bit of a correction, about an 8% correction. Now, here's another example of a very strong tech stock that was bullish and became a darling of Wall Street through 2016 into 17. Bullish personality change. The power gauge went bullish again in late September. The stock was about 18. And then after the election, when Barron's wrote up the stock, it spiked up to 23.5. And again, we got a bearish money flow sell alert. The signals work beautifully. These are the oversold buy signals rather. But when you see that new high, a spike up on some good news, positive earnings, and money flow is red, not green, great spot to take your profits. You certainly don't want to be buying it up there, but you want to be taking your profits. So 6 pairs of buy and sell signals in Chaikin. We've seen 2 of them. And again, the question comes up, well, it's great to see those signals, but how do I find them? So we've created dashboard alerts in Chaikin Analytics. I took this dashboard from a webinar I did about a month ago. I follow a list of 150 stocks, and every morning on that list, or any list in the system, ETF, index, I'm alerted to the buys and the sells when I open up the app. And on that particular day, a stock that had a bullish power gauge rating, PVH, make Calvin Klein jeans and a lot of apparel that people like, not high-end, mundane stuff, gave a relative strength breakdown at a price of 102.01. So let's see what that stock has done since that relative strength breakdown. Well, here it is on the chart. You can see that the power gauge had been bullish. It had been outperforming the market, and then it started to underperform. There's your bearish personality change. And with the stock market making new highs, PVH has gone from 102 all the way down to 89.31 on Friday. It shows you the importance of spotting these personality changes, following the signals. So now the final piece of the webinar on how you make money in 2017 is to use sectors and ETFs to find the best ideas. So we're going to show you how we rank the 10 select spider sector ETFs, how you can drill down on a strong sector to find strong stocks to buy, or in a weak sector, weak stocks to avoid, and then show you how to trade the ETFs themselves, or as an alternative, trade the best stocks in that ETF. So the underlying principle here is that strong sectors and industry groups give you a tailwind There have been studies done over the last 40 years that the strongest stocks and the strongest industry groups are your best performers. So they give you a tailwind. They put the wind at your back. On the other hand, if you're buying stocks in weak industry groups, bottom fishing, that industry and sector weakness is a headwind. It makes it more difficult, sometimes impossible to make money on the long side, but these are great opportunities on the short side. So here's how we rank sectors. We don't rank them just on price momentum. We actually look under the hood at the power gauge ratings for the individual stocks within a sector or an industry group. So in this case, the financial sector has 38 stocks with bullish power gauge ratings, only 3 stocks with bearish. Technology, 22 bullish, 3 bearish, and healthcare, which has not been performing well until the last couple of days, 19 bullish and 5 bearish. And then industrials, energy, and materials. Notice these are the 6 sectors, other than healthcare, 5 sectors that do well in a rising interest rate environment. We're going to look at 2 of them. And at the bottom, the usual suspects, utilities, consumer staples, and real estate. These are the sectors that do poorly in a rising interest rate environment. We're going to look at consumer staples, where only 2 stocks in this large cap sector have bullish power gauge ratings and 17 have bearish ratings. So here's the XLF, the Financial Select Spider Sector ETF. And it's done extraordinarily well subsequent to the election, but it was doing well on a relative basis prior to the election, because remember, we had 9 straight days down into the election. But the financials were actually up slightly in that period. And we know that because the relative strength is green, and we see that the institutions were buying, smart money was buying this ETF. Now, on the left-hand side, we rank the stocks in the XLF by Chaikin power gauge rating. And you see some of the stocks that have really performed well: Bank of America, Citicorp, JP Morgan, which reported a positive earnings surprise on Friday, Lincoln Financial, and Morgan Stanley, which we recommended back in October in our weekly market letter at about 31.5. It's 43, 44. Let's zero in on Lincoln, which gave a buy signal based on Friday's price action. So here's Lincoln Financial. It gave a relative strength buy. Remember, those signals tend to last 4 to 8 weeks. And here we see 2 of them on the chart. One came in September when the dynamic duo was working. The market agreed with the model. And that was about 3 weeks before a positive earnings surprise. And we know that because we color code the earnings icon, red, gray, or green. And then another relative strength buy right after the earnings came out, just before the presidential election. And up here we see that the next earnings report is due out on Wednesday, February 1st. And we have an earnings alert indicator that's telling you to expect a positive earnings surprise when they report 4th quarter results on February 1st. So on this one chart is everything you need to know if you're a swing trader or an options trader or an investor trying to grow your retirement nest egg. Now, the second sector that ranked based on the power gauge rating as bullish is technology. And technology is a sector that tends to do well in a rising interest rate environment. We already looked at Micron, which is ranked strongly. Right at the top of the list is AMAT, which had a very, very big day on Friday with the market sort of flat to up slightly, was up 1.5%. Let's look at the chart of AMAT. By the way, you can see on this sector chart that technology has been making a new high. That confirms the power bar ratings. Financials have been making a new high, but let's look at that AMAT chart, which is interesting because the stock has had a bullish rating since late 2015. It's been outperforming the market. Money flow has been, in the main, very strong, and the stock went from under 20 to 34. It's a pretty nice 70% move, but look at what has just happened. We've gotten a bearish money flow alert sell signal. The stock made a new high, and instead of money flow being green, it's red. So even though it's a strong sector and it shows that AMAT is ranked at the top of the list based on the power gauge, you don't want to buy it up here. If you've already owned it on one of these buy signals, and there was just recently an oversold buy at about 32, you want to be selling up here. Take your profits. Let someone else worry about whether that money flow signal is going to be a harbinger of weakness going forward. Now, I said early on that we're going to be in a stock picker's market in 2017. Typically, when interest rates are rising, the market is selective. We know that some sectors do well, some do poorly. It's a stock picker's market, and you've got to play good defense. Now, Seattle is out of the playoffs, but they're renowned to have a very good defense. So let's look at one of the weaker sectors, the consumer staples. We've already seen Coca-Cola as a bearish stock, and that's in consumer staples. Estée Lauder is a big cosmetic stock. So beverages, cosmetics, foods, all with bearish power gauge ratings. There's Procter & Gamble, a stock that Goldman Sachs just downgraded, where the power gauge rating's been bearish for 4 months. The sector itself had a bearish personality change back in May and then again in July. Chaikin Money Flow was weak. We had relative strength sell signals. These are the stocks you want to avoid. They do poorly in a rising interest rate environment, and they've got bearish power gauge ratings. So let's take a look at Estée Lauder. It's one of the biggest, most successful, highly regarded cosmetics companies, but it's been a terrible stock to own. The power gauge rating and relative strength both started agreeing with one another in mid-May. The stock was trading around 90, on its way to 75, and this is a stock where money is still coming out of it. Notice the red sea of money flow. Institutions are still selling the stock, and the power gauge rating and relative strength are still strong. Now, stocks like this ultimately find a bottom, so you've got to be careful about shorting them unless they're really overhyped stocks that are likely to go out of business, like a SunEdison. But Estée Lauder is not going out of business, but it is a stock you want to avoid. It's in a weak industry group, it's weak technically, and the power gauge is weak. So everything is lined up against this stock. Now, we have a screener in Chaikin Analytics that enables you to find ideas based on screening criteria, both from factors in the model and conventional screening criteria. So I wanted to give you an example of that. In this screen that I ran this morning, I started out with a growth stock universe of 1,768 stocks, and I screened for bullish power gauge ratings for large and mid-cap growth stocks, where money flow and relative strength were strong, are two key technical indicators. And then I added one other screening factor to narrow it down. I wanted insiders to be buying their own stock, and result is 11 stocks that qualified out of 1,768. This screen took me about 20 seconds to do. And there are some pretty good names on here. Citizens Financial Group, great regional banking stock, CFG. Alliance Data, automatic data processing. If jobs are being created, new businesses are created, they'll do well. But let's zero in on a stock that I like, AMCX, because I got familiar with the AMC channel through Mad Men and some of their other popular series. And let's take a look at that chart. Well, this stock had actually been in a downtrend with both relative strength and the power gauge rating bearish. It was a terrific stock in 2015, and then the market soured on cable stocks. This was a rumored takeover candidate. But now the landscape is shifting. Look at how the institutions started accumulating the stock in here starting in November. Power gauge turned bullish, and now the relative strength has turned bullish. So this is an interesting turnaround candidate. You went from a downtrend where institutions were selling to a much more positive technical trend with accumulation. And now I want to show you this very exciting new capability in Chaikin Analytics that we call our discovery engine. So big drum roll, please. This product was introduced just before Christmas on December 24th. And what it is a way to find stocks similar to the stock that you seed it with, that you enter into the symbol box. This is the same way that Spotify finds music that you're likely to enjoy, and Netflix helps you find movies that are similar to the movies that you've watched and liked. So what I did here is I entered AMCX into the discovery engine. It has a bullish rating, so it's now showing me in this top slice other stocks in the entertainment and media complex with bullish power gauge ratings. And I'm circling Disney because Disney is also in a turnaround. So it illustrates how you can find very similar stocks to one that you may like or have made money in, instantly generating 5 ideas to very quickly evaluate to see if there's a buy candidate in the bunch. Now, Discovery Engine can also help find swap ideas. So what I did here is I entered an insurance stock, RLI, that has a very bearish power gauge rating. Most insurance stocks have bullish ratings because the financial sector likes rising interest rates. So the goal here is, if you owned RLI, to find an insurance stock to swap out of RLI and into. And in the second slice, I've got potential swaps. And one of them, Everest Reinsurance, is a stock that I know very well. I also know American Financial. So let's see what Everest Re looks like. It's got a very bullish rating, so it's a perfect candidate for a swap out of a stock with a bearish rating. So here's the one-year chart of Everest Re. Well, it's had a pretty good move. It's gone from about 185 to 220 here since July. But notice that all 4 categories, components of the Chaikin power gauge, have very bullish ratings. So using the discovery engine, plugging in a bearish insurance stock, I was able to zero in on a stock like Everest Reinsurance as a potential buy candidate. Now, do I want to buy it up here at 220? No, I want to let it pull back a bit. It's gotten overbought. But in seconds, the discovery engine can find stocks like a symbol that you enter, or stocks that are potential swaps or high dividends and so forth. It's a very powerful capability, just rolled out, bundled with Chaikin Analytics. So you've now seen what Chaikin Analytics can do and how it can help you position yourself for 2017 with these patterns that we've honed over the last 5.5 years and have proven successful. It includes an options idea module, the screener, the earnings alerts, intraday charts, news, and now the discovery engine. So it's a complete package, and it normally sells for $1,950 a year. But before we show you a special offer, one more endorsement from John Malden. We had an endorsement from John Carter, who's a pure trader. John Malden's a big picture macroeconomic guy. He's got 1 million subscribers to his 2 free newsletters, widely followed by the institutional and brokerage community. And he said, I'm impressed by what Mark has done. My analysts are enthusiastic users of Chaikin Analytics and use it to analyze the trades and recommendations of our newsletter writing team. It's been integrated into our routine due diligence process for vetting and evaluating potential investments. So Chaikin Analytics, as I said, is normally $1,950 a year, but as a webinar special on MLK Day, we're taking $200 off the price, reducing it to $1,750 a year. You can go to chaikinanalytics.com/discover, and you'll see the offer pre-populated. It expires Thursday, January 19th. Or if you have any questions, you can contact our sales team, sales@chaikinanalytics.com, or call the phone number that's on the screen. Now, along with everything you've seen, there are 3 additional ways that we add value to your subscription to Chaikin Analytics. We have small group tutorials and some one-on-one sessions to help you learn the features that are important in Chaikin Analytics, and more importantly, how they benefit you, how to use them, how to get started so that you can be successful in 2017 right from the get-go. My colleague John Schlitz writes daily morning insights that come into your email before the opening, and I write a weekly market letter called Chaikin Market Insights that's in your inbox every Sunday, where I talk about what I think the market's doing and where it's going, and also highlight a bullish or bearish stock of the week and strong and weak industry groups. So it's a complete package. And as an added bonus, if you subscribe by midnight tonight, we'll take another $100 off the cost of Chaikin Analytics, reducing the price from $1,950 to $1,650. ChaikinAnalytics.com/discover. Joe Bacella is going to put up the link in a moment in the chat box, but we have a special fast action bonus. If you subscribe today by midnight, we will enroll you in a free 30-minute class that I'm going to give next Monday at 1 o'clock called Profit from Upcoming Earnings Reports. We're in the middle of earnings season. We've done complete webinars on how to use Chaikin during earnings season, particularly with options to make outsized returns if a company reports a positive earnings surprise, and stocks with a bullish power gauge rating very often do that, or a negative earnings surprise. So if you subscribe by midnight tonight, not only will we take another $100 off the price of Chaikin Analytics, reducing it to $1,650, but you'll have instant enrollment in next Monday's Profiting from Upcoming Earnings Reports 30-minute webinar. So with that, I'd like to thank you all for taking time out of your midday. Hopefully, we fulfilled our promise to show you how to make money in 2017. And Joe Bacella, I'll turn it over to you. And I see that Joe has put up the link in the chat box that brings you to our fulfillment page.
All right, Mark, thank you so much. And thank you everyone for spending some time with us this afternoon. As Mark mentioned, if you reference the chat box, all of our contact information, as well as direct access to Mark's discount offer here, is available. ChaikinAnalytics.com/discover. Or again, give us a call. I know there's a few questions about subscriptions. You can give us a call at 877-697-6783. I'll be more than happy to walk through. I saw there were some questions about some demos. Again, you can do a live one-on-one demonstration with a member of our support team. So again, don't be shy. Make sure to give us a call or visit us at ChaikinAnalytics.com/discover. With that said, we want to thank you all very much for spending some time with us. We have a full week of support webinars just for our subscribers, and no better way to get the week started than with this discounted offer from Marc Chaikin. So this webinar has been recorded, so keep an eye out for a recording soon. In the meantime, everybody have a wonderful afternoon, and we'll see you next time.